crowd. Yeah, exactly. There you go. Yeah, that'd be awesome. Thanks. Cool. Oh, we're good? Oh, we're on now? Hi. How's everybody? Okay, so oh, thank you, Dave. Oh, that's super sweet of you. Appreciate everybody. We got like 55 people in attendance right now. It's crazy here. It's absolutely insane. Exactly. So I'm Jason Mavora. I'm with Prosperity Lending, and today I'm going to talk a little bit about the stated income program that is behind me. This thing, stated income, for those of you that have been in the industry as long as I have, it used to be a very big situation before 2008, and then the market came down and crashed, and everybody blamed stated income, and rightfully so, quite frankly. There's things called negative amortization loans. There were loans that are over 125% loan to value, meaning let's say you were buying a home for $400,000 and you wanted a loan for much, much more than that. You could get it even though it was only worth $400,000. So it was a very different time then, and we all saw what happened when financing kind of ran amok, basically. This is going to be a bit different. This is kind of a more organized stated income, and this is kind of going back to where stated income started originally before everything got crazy. Hopefully it doesn't get crazy again, because this is the type of stated income that I actually like. This one kind of makes sense more than the other ones that obviously did not make sense. So we're going to dive into it a little bit. Beta, do I need a clicker or do I use the mouse? Oh, you got it? Okay. All right, cool. So we're on the next page. So first, let's dive into the type of properties that this works for. This program that we're looking at is what's called the light stated. The other one we're going to do is truly stated income. First one, we can do it on 1 to 4 unit properties, condos, PUDs, and co-ops. But really and truly, this is done by a venture capitalist. It's a bank that's working for a venture capitalist. So if you have a property that most likely the situation fits, maybe they put a little bit more down, maybe they have a better credit, there's a good chance that they're probably going to say yes. This isn't matrixed like an FHA or a Fannie Mae or a Freddie Mac or any of those type of ones where it's just here's your box and here's your loan. This is more of a, hey, this doesn't fit in our box right now, but tell us why we should invest in this, and you might have a shot. It doesn't mean that they're going to, but it means that they're going to listen versus the other ones that are going to be flat out like, we do not do non-warrantable condos. That is what it is. These ones are going to be different. So these are some of the property types, but there could be a lot more actually. Go next one. So who can qualify for it? Well, we've got anywhere from $100,000 to $1.5 million. You can go with 20% down. That's going to be a 720 credit score. So that's one of the reasons why this is a little different. They're not taking just everybody. If you have a heartbeat, you get a loan type stated income. You have to have a good credit score to make this work. If you have a 700 credit score, they're going to need you to put 25% down. And there are some scenarios where they can do a 680 credit score, but then they're going to ask you to put 30% down, and in some cases 35% down. They will go all the way up to $3 million is their biggest loan size, but again, that is subject to the situation. That doesn't mean purchase price too. If it, at $3 million, their best terms are 30% down. So if you're buying a $4 million home, loan size can be $3 million, and you're going to be okay. If it's, oh my gosh, this is just rough. Right now I've got a $4.5 million one, and we need a loan size of closer to $3.5 million. Again, they can say no, but they can always ask, is the situation. They don't stop at $3 million and that's it. These are just general guidelines. They are more doing make sense lending. If the situation makes sense to them, they will do it basically. But these are basically the situations for the down payment. They range, for the most part, all the way from 20 to 35% down. And 680 is the absolute lowest score that they'll take, but you just have to put more of a down payment down. Let's go next. They also do this for a second home and vacation home. We're going to get into a whole different slide for investment properties because they have a whole situation for that. But they will take this as a second home, and this is obviously the perfect city for second home. Vegas always works as a destination city for a second home. And the nice part is that they're not qualifying with their income. So if they want to buy a home here, we are telling them what their income is. A lot of times the problem with second home and vacation home is, oh, we can't show that they can afford their current mortgage and this new mortgage. The ratios just don't work, sorry. This alleviates that problem. And they are still going to $3 million on these levels too. So this is a huge situation for that person that might live California, Arizona, New York, any other different city, and wants to buy a second home here. They have to put a little bit more down. Up to $2 million, they have to put 30% down. Up to 2.5, they have to put 35, and up to 3 million, they have to put 40% down. So obviously, again, the ability to repay for this thing really comes from your down payment. These are good credit score people. that have a lot of money for a down payment. This isn't going to be the person that's like, hey, I've got a really good credit score and I got a good job, but I just don't have money right now. That's not this loan. That's going to be the regular loans, basically. This is for that person that's sitting on a lot of cash and can't show their income. And we'll get into who those people are later on here. So let's go next. They can also get cash out with this program. So let's say they're sitting on a home that's worth X amount of money and they can have a lot of equity. Say they have a free and clear home and they want to go out and buy that other one. They can refinance with this program, again stated income, buy another property with that cash, again stated income, and make it work. So it's got a lot of powerful tools to it. And let's go next one here. Non-warrantable projects is a big one in Las Vegas. They will loan to non-warrantables. They're doing 35% down, but they will loan to non-warrantables, which is huge. I-10 they will do as well. I-10 is a big one. Now this one could be a little bit more difficult. We run into, oftentimes I-10s are very hard to get done in the beginning, but to have a large down payment, it's usually a perfect storm if we're going to get that. But they can do an I-10 and they'll do it for 25% down. Their max loan is up to $1 million. And yeah.
New people?
Oh, yeah. Oh, sorry about that. That is going to be people that might not have lived here for a while, that are here legally through the system, might not have established credit, might not have established permanent residence here. They might be on a permanent resident alien card. They might be on a work visa. People that are basically from another country who are not official U.S. citizens yet. Sometimes it's kind of a gray area. Sometimes they get social. Sometimes they develop credit and they can get through that. Sometimes they go more through the I-10 type program.
What's the interest rate on the non-warrantable?
They're not that bad, actually. That's the thing. Is I'll answer the question first, but then we'll get into, there's going to be a slide where we get more into the rates. But most of these are going to be in the 5s with 2 points up front. When you compare them to regular Fannie and Freddie, you're like, gosh, that's high. When you compare them to hard money, which is where these people are going right now, it's not even close. Those are usually anywhere from the 9 to 13% interest rates with 3 and 4 points, and oftentimes they have prepayment penalties. This is kind of a hybrid. These are going to be in the 5s and sometimes the 6s with 2 points, and there's no prepayment penalty for these. So the money certainly isn't cheap. It's definitely not like you're still getting prime rates, but a lot of times for the people that we're going to be talking about for this situation, it fits their situation, and sometimes they're even flipping these and moving them, and sometimes they need to do a 1-year tax return and they treat this like a Band-Aid loan, and then they refinance a year later, basically. So sometimes it's a way to get them into what they need to do. Okay. Debt to income ratio. So weird statement here. Why would there be a debt to income ratio if this is a stated income loan? Well, this one's what's called the light version. The light version is, honestly, I can't even say a better way to think about it. It's kind of a joke. It's kind of ridiculous. But they'll let us go to 80% loan to value versus 75%. The light version is if they are a business owner and they can prove they've been in business for 1 year or longer, doesn't matter what type of business, including marijuana business, they can do any type of business. All they have to do is write a letter, an unaudited profit and loss statement for the last year saying how much money they made. It is not substantiated by anything else. It is not done by 12 months of bank statements to back that they're saying what's accurate. They just literally need to write a 12-month profit and loss statement. So what does that mean? They can write what their income is and they can write anything they want. So it's kind of silly, but they give us better terms, so we say okay, basically. So how we write it up is the main things that we need to know is, again, business for self for 1 year or longer. They have to have a business license. We have to have the CPA basically saying what percentage of the business that they own and when the business started. But the P&L is written by them, not even by the accountant for this scenario. So for business owners, this is a wonderful option that gives them a little bit of a better situation for it. And next. So cash reserves. For the loan size, if it's between, if it's less than $500,000, they only have to have 3 months PITI. And what PITI stands for is principal and interest, taxes, and insurance. So let's say their monthly payment is $3,000 a month. They have to show that they have $9,000 after this transaction's over. Anything between $500,000 and $1.5 million, they need 6 months of it. So that person would have to show they have $18,000. That doesn't mean they have to spend $18,000. They just have to show they still have it after everything's done. And then anything between 1.5 and higher, they have to show 12 months. So they'd have to show in that scenario, they'd have to show that they have about $36,000 in the bank after it's done. Now, what you're going to find is usually people that have 25% down, this isn't a big deal for them. Usually if they're coming with that and they're going to pay a higher interest rate and they're going to pay higher fees, they're going to have those reserves. So in some cases, yeah.
What about I know in most cases that's usually paid, by the seller.
No, this is their monthly payment. This is their reserves to show that they're not bankrupt after the transaction's over. So like, let's say that they needed 25% down on $1 million. That's $250,000. They don't want to see a bank statement that shows exactly $250,000. They want to see a bank statement that maybe shows $350,000. So they put it towards the down payment, and then there's money after, so that they're not broke after.
So usually on the contract, that's paid by the seller.
Yeah, that's going to be your transfer tax. That's going to be a different thing. What the PITA stands for is for principal and interest. The person that's buying the home still has to pay their monthly taxes and their insurances on that part. Yeah, that's a different thing there. But yeah, so usually this won't be something that's very hard to overcome. Also, too, in traditional loans, people usually have to do what's called source their money, of where all their money came from. If they see large cash deposits, if they see that somebody just gave them a check for $15,000 and they don't know who that is, they have to say where that money came from. In this, they don't. So this is very huge for people that are being creative with their money, let's say. It helps them a great deal. Next one there. So they have many different terms for it too. They have a 5-1 ARM, they have a 7-1 ARM, they have a 15-year fixed, they have a 30-year fixed, and what's most attractive is an interest-only situation. Now the reason why an interest-only is an attractive situation for people that are doing this loan is because it makes the monthly payment smaller for them. And a lot of people are treating this like a Band-Aid loan, that they're either A, going to sell the property soon, or they're going to try to refinance it when their situation gets better, if they can pull that off. So they want to pay as little as possible. An interest-only payment makes their monthly payment as small as possible. So that's something that a lot of people like for this type of program. But it's optional. They can choose all these different programs for it. And then next there. Alrighty, so how do they source the borrower? The borrower provides a canceled down payment check, a wire from their bank, so they have to show where it's coming from. So they are going to have to show a bank statement. They do have to show where their money is coming from for sure. All of the money can be a gift. There's a term that you guys are going to hear, especially if you're new. It's going to sound very strange. There's a term called a straw buyer that's in the regular loans out there. What a straw buyer is let's say that I have a lot of money, but my credit is really, really bad. My friend Dave has great credit, and he's renting, but he's not exactly ready to buy a house. What a straw buyer is, they say, hey, Dave, you act like you're the buyer for this since your credit's so good. I'm not going to be a person on this application, and I'm going to give you all the money to do this thing, and you basically buy the house for me under your name. That's a straw buyer. He's not really the real buyer. He's just doing it. The Fannie Mae's, Freddie Mac's, FHA, they're pretty good at finding out if somebody's doing a situation like that, and they source everything. For something like this, you can have that scenario for a straw buyer. You can have a person with really good credit, and they can front the money, because 100% of the money can come from a gift. So it's a little bit different. All they care about is that the person doing the loan has good credit and that they have the down payment ability. And then, let's see here. If there's a 1-month recent transaction, anything that's $10,000 or more that just jumped over, they are going to ask them for a letter saying where it's coming from. But again, it's just coming from the borrower. So the borrower can write the letter how they want to write it, basically. And the next one. Prepayment penalty. This is only for investors. If this is an investment property, there's a prepayment penalty. If they keep it for 1 year, they have a 3%. I'm sorry, 1 year is 3%, 2 years is 2%, and 1 year is 1%. If it's a second home, vacation home, primary resident, there is no prepayment penalty. Only investment properties carry that part of it. And the next one there. Credit overlays. This again is why this is very different from back in 2008 is, again, anybody with a heartbeat could do a state income loan back there, basically. You'd have to be really, really bad not to qualify. For this, some of these are actually past the guidelines of where Fannie Mae and Freddie Mac are. If you have a Chapter 7 or 11 bankruptcy, it's 4 years from the discharge date. Actually, it should be 13 and 12. We need to change that there. It's 2 years for a Chapter 13 bankruptcy. Foreclosures are 7 years from a foreclosure date. Short sale is 4 years. Forbearance is the only one where they're nice on, just because everybody knows what happened in 2020. If it's a situation where it makes sense for them, then forbearance is case by case. And then anything over $1.5 million is a second appraisal. So a little different there too. So what does it cost? What are the rates? We'll jump into there. It's 2 points up front for all of them, no matter what program they're doing, no matter what situation. Everything that we're going to be talking about is going to be 2 points up front. And what is a point? A point is 1% of a loan size, not your purchase price, the loan size. So let's say you're buying a $1 million home and they're putting 25% down. 25% would be a $750,000 loan size. They'd take 1% of $750,000, and that would be $7,500. They're charging 2 points, so it'd be $15,000 in that scenario. So the more expensive this goes, the more expensive it goes. So again, this loan is not cheap. This loan is not, we are selling on this one service and the ability to do it, basically, and the speed. Because all we need for this thing is an appraisal and basically an application. We'd be able to write contracts for this much faster than 30 days. It's basically how fast we can prove their assets and we can prove their the appraised value. Loan's pretty much done at that point, so there's not much to do. It's definitely not going to be pricing that we're selling this on. The only thing that we've got the advantage pricing on is if we're competing against a hard money lender to the best of our ability is the only one that compete with a product like this, we're going to blow them out of the water. We're way cheaper than them. If they're like, well, my bank told me we're at 2.75, it's like, yeah, let's see if your bank can do this. That's going to be the base thing. And once they realize that they're kind of in a rock and a hard place, that's where things are going to change for them a little bit. But this is a service loan for sure, and this is a speed loan for sure. And then do we have any other team? Oh, and then that's me, of course. Pop over if you need anything. We also have Angelique in the back. She is our marketing director. She does things like this for the project. She does digital flyers. If you guys ever want to pair up with her for like Instagram, for Facebook, and you want to be able to send some of this stuff out, make it clickable to go to apply online if you have anything like that, or if you just want any general information, you can talk with Angelique after the presentation, or for the people watching, you can definitely email her. She's with obviously the Prosperity team, and she can help set something up for you, and hers is free of charge. She doesn't charge you to help set those kind of things up. And if you'd like to set up something that's more one-on-one with me, she can help set those kind of things up too. So, and she's right back there. Actually, I just thought about it. Let's skip the investor one, just because that one went a little longer than I thought it was. Let's go right to the no-doc one. There's only a little bit of a variation for the no-doc one. Now, this is for your wage earner. This is for your person that can't prove, well, what if I'm not a business owner? This is going to be a little different. Let's go ahead and go to the next one there. Same type of properties. And next one again. Values are pretty similar. If you notice, there's not a 20% down option right now. Now there's the lowest one is up at the top for 25%. If they're a wage earner or they can't prove that they've been in business for a year or longer, this is going to be your business owners that might have just opened their business 5 months ago and they say, gosh, I did so much better than I thought. I want to buy a house now. But they have no tax returns and they just started a little bit ago. This is going to be more for them, basically. This is going to be more for your person that, again, all of your marijuana ones that are out there. Those ones are federal programs. Those programs, quite literally, they don't recommend that, they don't recognize that income from anywhere out there. So even like the accountants, even the owners, everybody involved, they don't have income according to federal government. But according to this, they do. They can use that type of situation. You've got your people that are out there that are cocktail waitresses, that are in the service industry. A lot of times they don't report their tips, and because of COVID, they're being told no, and they're being told, hey, go back to work for 6 months and prove that your income is better, and then we'll bring you back, basically. Those people are the ones that can use these type of programs. So there's a lot of possibilities for this situation, basically. Let's see, they're still doing second and vacation homes for this. It's just a little bit more down, basically. Let's skip to the next one there. They're doing cash out refinance again. Again, it's just more the loan to value that goes down a little bit. And let's go next one here. Income verification. This is the fun one. There is no debt to income ratio. They are literally leaving the application blank when it comes to what they do for a living. In the normal spot on the application where it says I'm a dentist, I'm a pharmacist, I'm whatever, that spot is literally blank on this application. They're never going to ask them what they do for work. Okay, next spot there. Do they still need assets? Yes, they do. That's the part they still have to show. They have to show 1 month of bank statements. It's the same. Loans $500,000 and lower, 3 months, 500 to 1.5, etc. So nothing's changed there. Next one here. Same exact products as before, same interest only. Nothing changes. So how they source their income, exactly the same. It can come from gifts. So there's not much difference between all of these, basically. The main difference is going to be that they just literally don't have any income in the box, and they're putting an extra 5% down. It's really the truth of it. So, excuse me, a little cotton mouth there. The sum up of this whole thing, basically, is if you have somebody that for whatever reason is being told no, they're being told that they're looking at their business tax returns and they just can't do it. The main question that you're going to want to ask your person that's trying to buy the home is, how much do you have saved up? Do you think you might have the ability to put 20 or 25% down? If the answer is, oh, gosh, no, there's no way. Getting this 5% is really, really tough, then it might, thank you very much. Then it might be is what it is in that scenario. It might be just rough. Much better, thank you. If, though, they say, yeah, we've been sitting on a nest egg that we've had for a while, we really didn't want to tap into it, but if this is what we have to do to make this work, that's probably the person that you want to recommend for this situation. This isn't, if anybody is speaking about grant programs or home as possible programs, you probably don't want to swing them to this. I mean, you can definitely suggest it, but probably not, basically. This, again, is going to be for the people that have been told no, or the people that you know have been in a situation that has been affected by COVID, but it's better now. They really are being hard on those people, quite honestly. They're doing some stuff that I believe is unfair, but who am I? I can't really change the rules for it. Most of these people have to be back on the job and show at least 6 months of continuous income. They're taking away their overtime, they're taking away their bonuses, and they're barely giving them their 40 hours when we all know they're making more than that right now. So it's a little frustrating. So this is a backdoor approach, basically. This is a way to make that work. And especially if you get into the higher level investment people, the ones that are going from 500,000 all the way to 3 million, you're going to find that the rate and the money is not going to be nearly as important to them as getting into that house, and a lot of them are buying it either A, because it's their dream home, or B, they have other plans with it. They're expecting to do something with that property. This cost isn't going to affect them too much. They've been in a world where they've spent much more than this, basically. So that's pretty much the sum up of the whole thing, is really the truth of it. Yeah, it's going to open up to questions.
So
Sure.
there's no need to look at the tax returns, right?
Not at all. We do not talk to the tax returns at all.
And then when you do write the offer for them, is it written as like a loan, or it's written as a cash offer?
Nope, it's written as a loan offer. You'd basically, like how we'd write a pre-qualification letter would still be from Prosperity. Even though we broker to a company called Quantic Bank that's back in New York, who's the one that's kind of bankrolling this program, but we work as a broker partner with them. But your pre-qualification letter would still come from me and from Prosperity Lending. It would still show up. It would show up as what's called a non-conforming loan, which is when anytime that you go into the jumbo level or you're not using Freddie Mac, Fannie Mae, those kind of situations. But it shows up as a non-conforming, and let's say they are putting 25% down, it would say loan size $750,000, purchase price $1 million. So your pre-qual letter will actually look strong, is really the truth of it. It'll have somebody that the only thing the seller is going to see is somebody putting a large down payment, which usually is what they like. I don't think so. Mobile home, usually, most lending programs, especially ones like these, mobile home's not usually their thing. What they're trying to do is get as much of a loan to value that's low as possible on a home that's desirable. Most lenders, as horrible as it sounds to say out loud, mobile homes are usually the bottom of the pecking order. Out of every type of home you're talking about, that's usually the lowest on the list. We can definitely ask them, but they haven't mentioned mobile home at all, and that usually means no. Even if they've been converted, they're usually the highest risk out of all properties that they lend on. But we can definitely ask them, that's for sure. Yeah.
With this one, with the wage earner one, can you still buy through the LLC even though it's like less than a year? LLC's existed for less than a year?
Yes, because they're not going to ask about the LLC, and they're not going to ask about the wages. They're not going to ask about anything. They're just going to basically leave that section blank. So for this one, that person who switched from corporation to wage earner and has played a lot of games like that, they're not even going to notice it on this one. So this is perfect for that scenario.
They want to see the money season, obviously, too, right?
Yes and no. 100% of this can come from gift funds. So if all of a sudden their rich uncle cut them a check for $300,000, they're going to want to ask where it came from, but it doesn't have to be seasoned. They're not going to care.
But does it have to sit in there for like a month or something? You know, like
Not-
the statement just needs to say, I have $300,000, not John gave me $300,000 yesterday.
Kinda, yes.
Underneath your mattress and then pop it in the bank.
Exactly, and pop it over there. They have to write a letter saying where the money came from. It's not like Fannie Mae and Freddie Mac, where they're like, no, if we see that, we have to source it. We're not going to accept cash under your mattress, et cetera, et cetera, et cetera. This one is more if they have cash under their mattress, they have to explain where the cash came from, basically. They have to have something that if they literally say it came from my mattress, they're going to be like, that's cute. How did it get under the mattress? Exactly. So, yeah, exactly. So they're going to have to explain themselves, and they do have the right to say no if it's like, oh yeah, we just knocked off a bank, and this is from robbing the bank. They'll be like, yeah, no, we're not using that. So it's not airtight going, no, you said you can use anything. No, if
Can
it's
you
going to
say,
be
like-
ridiculous, no.
Like, I've been really lucky at gambling for the past something years, and
What-
I finally deposited in the bank.
What they could counter back with on that one, it's up to them, but they could come back and say, okay, well, when you win a lot of money gambling, you have to report that. Then they want to see the reporting. Yeah, so it has to make sense still. So they're not,
Wait 2 weeks and pull the next month's statement.
exactly, but and what Dave said is not exactly the worst thing in the world. I hope everybody heard that part. They're only looking for a 1-month bank statement. So let's say you have that exact situation. They've got a bunch of money under a mattress and they just do not want to explain where that is. We tell them to deposit it right now, put this on hold for a month, come back next month when you have a new bank statement. They're only asking for 1 bank statement. So
Is
it's their-
there like this loan is gonna end at a certain time, or like?
It's a very interesting question, and that's one of the things, because we all heard that. Nevada is a state that's called you have to be able to show the ability to repay. They did that after 2008 because they wanted to do away with state income. So the second we heard this thing pitched to us, everybody raised their hand and goes, how are you getting past the ability to repay? They had a couple of reasons that they came up with. And again, this is what they said that their lawyers said. Whether it's true or not, we're going to find out, basically. But what they said is, number one, with the credit scores being high and the amount of money being put for the down payment, that shows an ability to repay. Number two is they're saying they're a federally chartered bank, and they said that their lawyers talked with the state, and the reason why we're allowed to lend here is that federal supersedes state, is what they said. So why I say that we'll see is because I'm sure that that's going to get tested someday. Eventually, somebody's going to get wise, and they're going to take a loan out for here. It might not happen soon, but it might happen in the next 6 months, a year, where they're going to say that they missed their payments because they didn't have the ability to repay. Some lawyer will tell them that this is the ability to repay, and if they got a stated income one, then they should be able to sue back. So they'll bring a lawsuit up against this company. I guarantee you, it's only a matter of time before it happens. And then we're going to find out who wins, is really it. When the court decides, if the court decides, no, you showed the ability to repay, all their arguments are correct, you did have the ability, you're going to see probably a whole lot more stated income programs coming through. If you see that that customer wins and Quantic has to write a check for $750,000, that'll probably be the last day we do stated in Nevada. So our unofficial stance on it is we're brokering, number one. It's the other company that's taking the risk for it, and their lawyers are the ones that are saying what's going on for it. Number two is they're the ones that are going to get sued, not us. And so it's kind of like one of those things going, okay, you guys have tested out, let's see if it works, basically. So that's why we're brokering with them.
Is there something you have to do to prove that it's a primary residence, like the water bill has to be in your name or something?
They haven't asked for anything like that. It just has to kind of make sense, is more it. So like, let's say they're buying from China. We have to do that as a foreign national program, not a here type situation. But there's not much to prove that it's not going to be an investment versus a primary. That's kind of why we started with the light dock one, to kind of show that pretty much anything can become a second home here in Las Vegas. So it's going to be very, very rare that we're going to do an investment one. That's for sure.
Jason,
Yeah.
you may have covered this in the early payment penalty thing, but
Mhm.
is there any, can you sell like within a year, 6 months?
You can, absolutely. There's no prepayment penalty for this on anything that's a primary, vacation home, or second home. Anything that's an investment has a prepayment penalty to it. So that's a huge factor. We have one that's going on right now that fits exactly the situation. And if you're at the meeting yesterday, I kind of talked about it a little bit. They're buying for $1.4 million. Their loan size is going to be $1.1 million. Their tax returns, lack of a better word, are ridiculous, and they know that. They're going to have their 2020s amended and done. They're going to do their 2021s, and then next year their plan is to refinance it when they have tax returns that are, let's call them normal, in 2020 and 2021. So that's their plan. And there is no situation where they have to pay any type of prepayment penalty for it. That's why they're going to go the interest-only route, so they can make the payments as low as possible. So then when they refinance into a conventional one, they can start doing principal and interest payments then when the rates are back to where they should be for them. This person has an 820 credit score, fantastic. She's been an optometrist for 20 some odd years. She's putting 20% down. The type of person you want to lend to. But when you look at the tax returns, yeah, can't do that. So she fits this mold perfectly, basically, of what we're doing. Yeah.
When to close the loan? 15 days or 30 days?
We're finding out. This is a new product. We got our first couple that are in the hopper, but we're guessing. I mean, if we don't have to prove income, proving income is what takes the majority of the time for us. We have to check verification of employments. We have to get it through underwriting to have them agree with our income. We have to do a whole lot of things. And out of the entire loan process, I'd say 80 to 90% of it is coming up to the same income and making sure everybody's on the same page. With that being eliminated, it should be as quick as showing the assets, showing the appraisal came in at value, and that the home is, lendable, that the home's in good condition. Show the assets, and we're done. So we're expecting this to be a very quick loan.
And then, Jason, on the CPA letter that you talked about earlier,
Mhm.
that letter indicates what? Like-
That letter just basically indicates that they've been in business for a year or longer.
Oh, that's it.
Yep, that's what they're looking for. And in some cases, we can just grab the business license and just show that they've been in business longer for that one too. Yeah, but the actual profit and loss statement, that's written by the borrower, not a CPA. So that's why it's kind of ridiculous, because nobody's checking to see if they're actually, if it's right or not. So it's kind of, you kind of laugh at it and go, okay, if that's the rules, then that's the rules. We'll get you a letter. Yep. Any other questions? Cool. All right. Well, thank you all for the time. I'm going to hang out and have sandwiches. Thank you, thank you. And if you guys have any questions, we'll be around to kind of hang out with you. So thank you for coming. For sure.